ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም። ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ትችላላችሁ።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ልምድ ባላቸው መምህራን እየተማራችሁ ጥያቄና መልስ የክፍል ስራዎች ፈተና መፈተን ክፍል ውስጥ እንዳላችሁት አይነት በኦንላይን ባላችሁበት ቦታ ከናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
So I just want us to go straight away to today's discussion, and which will continue with tomorrow. But as I was saying, the important thing is for us to understand some basics of investment and the channels of investment, the vehicles of investment, the markets that we can invest into, and the basic requirements that one needs to have so that he can come up with a proper investment portfolio. All right? So that now, next time, we'll introduce that. So allow me to share the screen so that we can move together. I hope you are able to read that.
Yes.
So we are talking about investment analysis and portfolio management. Investment analysis and portfolio management course helps entrepreneurs and practitioners to understand the investments field as it is currently understood and practiced for sound investment decision making. So the bottom line is, are we able to make sound investment decisions as managers? That's why we have to study this course. We consider key concepts that provide an appreciation of the theory and practice of investment, focusing on investment portfolio formation and management issues. So we are more concerned here. There are some of the theories we're going to talk about, like the Markowitz theory of portfolio formation, risk diversification theories. So there are a number of financial theories that you're going to come up with as we are going to discuss portfolio formation, and which lay the ground for portfolio formation or portfolio decision-making process, or portfolio as an element in a finance area of study. We emphasize both theoretical and analytical aspects of investment decisions. As much as we understand the theory behind portfolio formation and management, we also apply the analytical aspect of it, where we need to get quantitative data. We need to compute like the expected return. We need to compute like the expected risk in our portfolio so that we make decisions based on those findings after we've done those kind of analysis. Modern investment theoretical concepts and instruments, and both descriptive and quantitative materials on investments. So we will need to even try to use modern models, and that's why we study markets. And I know one of you is going to address the issue of markets, because markets play a lot in terms of determining where to invest and where to source funds from. And the decisions that we make must be actually, they must reflect the economic variables that are prevailing within the market. So that's why market plays a major role in some of the decisions that we make as managers for investment purposes. So we have both corporate finance and investments are built upon a common set of financial principles, such as the present value, the future value, the cost of capital. You know, these are some of the issues that are actually needs to be considered if you are to form an accurate or an appropriate portfolio that will maximize your returns and minimize the risks. Because that's the bottom line of doing your portfolio analysis. Because essentially you want to come up with a return that can be maximized and a risk that can be minimized. Later on, we shall be looking at the investment process. How do you evaluate the process that you need to go through when you are evaluating a project? So this is one of them, because you have to understand why you are actually interested in investing in this area. The instruments that you need to use. So we can use quantitative and qualitative. Qualitative could be the information that is available in the market. Quantitative could be statistical data that is available in the market. It could be also the financial statements, data that you have. Those are statistical information. But qualitative is the information that's available in the market. So these are some of the things that we are going to look into as much as we want to evaluate projects and come up with the most appropriate portfolio formation that we need to come up with. Very often, investment and financing analysis for decision-making use the same tools. They use the same tools, but the interpretation of the results from this analysis for the investor and for the financier would be different. Now, as I had said earlier on, we had 4 basic investment decisions that managers make or finance managers make. We had investment decisions, we had financing decisions, we had dividend decisions, and we had liquidity decisions. The first 2 are paramount. And they're the ones, if they are well taken care of, then they will result into the following 2. That's what I'm saying. That's what I'm saying. So if you have proper investment appraisal processes, proper financing appraisal processes, then you're good to go. Because the results will be now the dividends that you need to now to decide whether to pay or not. Or the levels of liquidity that you require, all right? Because some investments will end up even financing your operational activities. So that's why we say it's key that we understand these 2 basic investing decisions that we make or financing decisions that we make, so that they can help us move forward in terms of portfolio formation and making decisions about them. So what I'm saying is we have 2 ends. We have one who is trying to invest, And as much as he's trying to invest, he needs to borrow. So if you need to borrow, then there is that one who is the provider of funds, who also has to make evaluation decisions to see who is capable to receive these funds and repay these funds. So we are looking at it from the borrower's point of view, and again from the lender's point of view. And that's why the market comes in as an important element in this decision-making process. Right? In the market, we have different types of markets. We have capital, we have money market. In the money market, all right, we have savers, people who are just there to save. They are saving. And there are those ones who are borrowers. So the money market provides, is an intermediary. It mediates between the borrowers and the savers, so that they save the money, and then the money that they have saved on your behalf can be used to lend to those ones who are interested in the borrowing. So this is the market playground, isn't it? And everybody or banks come in, play, they are part of the players or participants. Borrowers are part of the participants. Lenders are part of the participants. So all these are now the issues that we need to go into so that we understand the basics of this area of finance, and actually understanding why portfolios analysis is very important. So what an investor's objective, or the reason why he may want to go through this process, may be different from the reason why the one who is lending, who is in the business of lending, may want to go through. Okay? Because the two have different objectives. One, his aim is to invest. And you remember, when you are investing, like as much as you are saving, you are also investing, isn't it? But as much as you are lending out, all right, you're also investing. So the whole process is investment. And that's why the irony comes in, and we need to identify that and critically analyze that from those perspectives. As we continue, if you have any question, feel free to just come up so that we move together. What are the prerequisites for investment analysis and portfolio management? What do you need to know, or what do you need to take care of as much as you want to analyze these projects? Because a market is so wide, and there are so many openings. Why do you choose this one and leave out the other one? All right? There are so many openings which are available. You can invest in tourism, you can invest in a hotel, you can invest in agriculture, you can invest in manufacturing. Why do you choose this one? Okay, so the market is so wide. But the issue is, what is the bottom line for your, or what is the basis of your investment decision? So an investor should be able to, one, you should be able to describe and analyze the investment environment. Are you able to, do you understand your investment environment? Where do you want to invest? Do you want to invest in Addis, or you want to invest outside Addis? Hello, are we there?
Yes, doctor. Yes, doctor.
Good. So Girima, it seems like he's lost. So my question is, these are things that you need to think about, like environment. The environment that is prevailing in Addis is different from the environment that is prevailing in another town in Ethiopia. It could be the same country, but different towns or different locations. Then the environments are totally different. So those are some of the considerations that you need to put into consideration. Do you want to invest in Kenya, whereas your base is in Addis? Okay, let me put it this way. Do you want to do a foreign investment? Do you understand the environment where you want to locate your business? No, those are the things that you need to be aware of. And environment is too wide. You know, when you talk about environment, there are a lot of variables that we need to think about. Different environments have different investment vehicles, have different economic variables, like the living standards, you know, like the number of competitors. You know, those are factors that are real and needs to be considered. How many people are offering the same business line that you intend to offer? All right. How is the market flooded? You know, what's the level of demand for this kind of product that you're going to offer in that market? So these are the things that you need to talk about, and they are part and parcel of the environment we're talking about. So you need to describe and analyze the environment, different types of investment vehicles, right? So if you know the environment and you understand the environment, then you'll be able to come up with a proper investment vehicle or the type of investment that you need to put into that kind of business or in that kind of location, given the circumstances that are prevailing in that area. Then secondly, you need to understand and explain the logic of investment process and contents of each stage. Each stage. Investment process has different stages, right? And later on, we shall be looking at the process and the different stages that we need to consider as much as we are looking at an investment, we are evaluating an investment project. So there are those different stages, and this is where we need to understand and be able to explain the logic of investing process so that we are able to make informed decisions. Then thirdly, we should be able to use the quantitative methods of investment decision making. All right. Now the quantitative here is now we should be in position to be able to estimate, because we are dealing with the market. And then now the market is so unpredictable because the fluctuations in the market are unpredictable. And they are dependent on a variety of factors, which can be in your favor or can be against you. So the thing is, are you in a position to anticipate, right? Or come up with proper estimates of probably expected returns in a project, given the environment in which it's operating? So first and foremost, about the environment, but then now, here comes in now the issue of the quantitative variables that are we able to collect those quantitative variables? Now, and this will help us be able to calculate the risk and the expected return of various investment tools and the investment portfolio. So we can calculate for each investment in our portfolio, and just as much as we can calculate for a full portfolio. Now, the next one is we should be able to distinguish concepts of portfolio theory and apply its principles in the process of investment portfolio formation. There are basic principles that we need to understand as put forward by different authors that would give you or would yield you a most appropriate portfolio that will actually maximize your returns and minimize your risks. Things like the correlation coefficient, things like correlation coefficient, things like the number of portfolios that you need to have at any given time, things like the levels of financing. So all these factors have to be considered, and you must be aware of them as much as you're trying to come up with a proper portfolio. Then we should also be able to analyze and evaluate relevancy of stocks, bonds, options for the investments. Now, when you talk about portfolio, we are not limiting ourselves to a certain or a specific kind of investment. Here we are opening ourselves up into a variety of investments. And sooner or later, we are going to see that we can invest through different channels or through different vehicles. We can have common stock, we can have fixed return bonds or short-term investments. We can, there are several of them, and we can have now a whole combination of all that. So you must have, for you to incorporate like investment in stock into your portfolio, then you must be able to understand and be able to evaluate the relevance of stocks, bonds, options for the investment. What purposes, you know, how do they operate? And what are your expectations if you are putting in bonds, or if you are investing into bonds as part of your portfolio? And it's not only that, but you are more concerned about the contribution towards the final return of the portfolio. Then next, we need to understand the psychological issues in investment decision making. As much as we are managers, we also have attitudes, and this is allowable in finance. Gerima, are you there? Emebet?
Yeah, I'm here.
Gerima. Okay, so what I'm saying is as much as we're investing in this kind of investments, we need also to understand the psychological issues in investment. If you are investing in a certain area, you must understand the psychology of your customers, the perception they have about your product, just or the product that you intend to give them. Those are some of the paramount issues that you need to consider. Even as managers, even us, we have different perceptions or attitudes, all right? Some of us are risk averse, some of us are risk takers, so that has to be considered, the psychological issues of the decision-making process and the decision maker. Because process now will include even the customers. The target customers, because we have different types of customers, so we should understand the customers we are targeting and what is their psychological take on products or service. Then we also need to understand, to know active and passive investment strategies to apply them in practice. Now, we have different practices in or strategies in investment analysis. We shall look at that later on. We have active and passive. So what's the difference between the two?
Hello, doctor.
Yes.
Hello.
Yes, Emebet.
There is no quality in the sound, doctor.
In my sound?
Yeah.
Quality or
quality problem? Yeah.
Am I
it's not
breaking?
clear. Yeah, there is.
Am I breaking?
Yeah. Wait. I think.
Okay, let me readjust. Yeah, let me readjust my connection.
Okay.
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
Okay, you can hear me clearly now?
Yes.
Yes, doctor. Yes, doctor.
That's
It was
good.
So I'm clear now.
Yes.
All right.
Good.
So I was just talking about the last point in this slide, which is we must understand the passive investment and
active strategy.
And yes, the active and the passive investment strategies. So there are two basic investment strategies: the active and the passive. We'll later on understand what they actually mean as we progress.
Okay.
Then types of investors. There are two types of investors. We have individual investors and institutional investors. Generally, we can classify them into two.
Okay.
All right?
Yes.
So, what is the difference? Individual investors are individuals who are investing on their own. Sometimes individual investors are called retail investors. People who are investing on their own. Let's go further and talk about institutional investors so that we can understand the difference. About institutional investors are entities such as investment companies, commercial banks, insurance companies, pension funds, and other financial institutions. They can achieve economies of scale, demographic pressure, or social security, and changing role of banks. Now, these ones, they actually, the difference between the first one and the second one, these ones actually pool resources. Like when you talk about a pension fund, how does it operate? Everybody who is an employee is bound to contribute towards that fund. But the fact that it's an employee is bound to contribute towards that fund. But then now, whatever is contributed every month can be invested as a pool. All right? So we are having smaller units being collected together, coming up with probably a huge investment vessel or a huge capital that can be invested. All right? So that people can actually, who may not have means of reaching where they have reached, can use the vehicle that is now the institution, can use the institution so that they can be part of the investment, but through the institution. So those are the institutional investors. The beauty about these ones, like mutual funds, you know, the beauty about these ones is they can achieve economies of scale. All right? Because when you are many, look at the example of the insurance company. How does it operate? Many people are part of the insurance companies, or they are policy holders. All right? But not all of them may end up getting the risks or incurring the risk. So you may find like a smaller percentage of the people who took the insurance at the beginning of the year have actually incurred the risk. So you find because of whatever they had paid, that money can be used to offset whatever. Yeah, and even the companies remain with a huge amount of profit. So that's the concept behind institutional investment or institutional investment. Then again, for successful investing both for individual and institutional investors, there should be a favorable investment environment. Now, investment environment is dependent on several factors. We must have the will in terms of the government, in terms of the political environment. There are so many economic environments and all those inflation. Those are some of the economic environments that we can consider as much as we want to make such kind of decisions. The basic principles of investment management are applicable both for individual and institutional investment. So whenever we are making decisions, such kind of decisions, we can be making for an individual. That's why we have even consultants where people approach you and ask you about what they can invest and where they can invest, or how much they can put in certain projects. So these are some of the parameters that need to be considered. And the evaluation process is basically the same. This is what we are talking about. Because as much as we are studying the course of portfolio analysis, we are more of concerned about the evaluation process than actually the physical investing. So we'll be looking at the decision-making process, more of the investing process. So we should give the right advice, and people should appreciate the stages that we go through for us to arrive at certain advices or certain decisions. You have direct versus indirect investing. Investors can use direct or indirect types of investing. What's the difference between direct investing and indirect investing? Direct investing is realized using financial markets. Investors buy and sell financial assets and manage individual asset investment portfolio themselves. That's direct investing. Investing directly through financial markets, investors take all the risk, and their successful investing depends on their understanding of financial markets, its fluctuations, and on their abilities to analyze and evaluate the investments and to manage their investment portfolio. So, just as much as we had said earlier on, you have two types of investors. We have individual and institutional.
Institutionalists, yes.
So an institution can invest in itself, and an individual can invest in himself. And when you talk about an individual, we are talking about a corporate entity. An institution, we are talking about a corporate entity. So these organizations can either invest indirect or directly, because an institution can also invest direct or indirectly, or an individual can also invest direct or indirectly.
Okay.
So we need to understand this. Okay, so we shall be using some of these terms as we go on, and that's why I took time to explain some of these terms as we are going to continue with the portfolio analysis in detail, so that we happen to meet some of these concepts. We should be able to understand them.
Okay.
So indirect investing involves financial intermediaries. Investors buy or sell financial instruments of financial institutions which invest large pools of cash in financial markets and hold portfolios. So it relieves investors from making decisions about their portfolio. Now, the beauty about indirect investing is like, for example, I don't know whether this one is happening in your place, where you can buy shares or you can invest in a broker, or you give him capital, you give him funds. You put funds like a number of some amount of money. Then their work will be to be looking around which shares are profitable and which one are not. With that amount, But then when they get returns, then they share out so that you also get a share of the returns. That is like this kind of indirect investment. You bought shares, you're not just playing on those shares that you hold or you bought, but because you bought those shares, you can pass the rights to the broker so that he can trade with your shares, and if he makes any returns or any profits on those shares, then you share in a given percentage. Okay, so that is happening, and it's a kind of an example of an indirect investment. It's different from where you just buy shares and have the shares. So when you want to dispose them, you just dispose them as a whole, and you look at the price that is prevailing, and then you determine the price, you sell them, get your money. Okay, but again, now that limits you to one particular company. So, and again, as you know, shares, ordinary shares have no right of dividend. So sometimes the company could be doing badly so that you are not paid dividends. But when you give them the rights to trade with your shares, then they can dispose of those shares, buy shares that are active, right? And then now you'll be able to earn you some dividends. I think that is some of the issues that are happening in the market with regard to indirect investing. So investors do not have to undergo the process of making decisions on which investment to make, to invest in, but you give it to the institution, all right, or to the broker to do that for you on your behalf, because he has more knowledge about the market. He has more understands the area than you do, all right. So most of the laymen who may not understand this concept of shares and where to invest and when to buy and when to sell, then that they could opt for that in return for some dividends, which probably the organization would have done on their behalf. As shareholders, with the ownership interest in the portfolios managed by financial institutions, that could be investment companies, pension funds, insurance companies, commercial banks. Sometimes there are those insurance companies, they invest part of this money into certain projects, and when they earn interest, all right, that interest is loaded onto your pension, so that when you are retiring, for example, the lump sum you are supposed to get as per your contribution, then there's some interest percentage that is loaded on, right? This interest is actually created through this together of funds that can now be invested as a huge amount into some certain project, which if you are an individual to invest in such projects, you will not. And that's why you're given like the commercial bank, because small savers will save with the commercial banks, but commercial banks put this money together. They can give as a loan to huge investors so that they pay them huge interest. And when they pay them huge interest, this interest is shared to the small savers, and then it's part of the earnings or return to their savings. So the whole concept is being played in the market. But as much as we are talking about this, then the important thing is we need to understand the market and how it's operating at a given time. Any question before we proceed?
No.
Irima, do you have a question?
I don't have a question.
Emebet?
Better to continue.
No, no, I don't have it, doctor.
Okay. So now, when you talk about returns, then we cannot avoid the risk. So the risk of investor using indirect investing is related more with the credibility of chosen institution and the professionalism of portfolio managers. So as much as we are talking about investing in through institutions, there is the element of identifying the right institution. Which institution is most appropriate? And then now you need to have prior knowledge of the available institutions that you need to invest in, and those ones that are promising and are doing well. That's why we need to understand the market. And there's an area talking about the markets. Okay? Because the risk is more about understanding the market. It's actually the deviation from the expected and the actual. Right? And the market is where the information is available about certain issues that you need to consider as much as you're preparing or you're evaluating projects. You get all the information from the market. So it's paramount that you understand the market and know, all right, if you understand the market better, then you should be able to make informed decisions, because essentially we cannot operate in isolation. We'll always operate within the market. Now, the risk of investor using indirect investing is related more with the credibility of chosen institution and professionalism. So what kind of managers do they have? Professionalism. Are they credible managers that one can rely on when it comes to making decisions about where to invest? Like if you are looking for a consultant to help you make a decision on investment, what are you supposed to look for? Who is behind that consultant? Are there people who are credible? Not anybody who can give you a wise advice that will help you grow in terms of your investment. The financial institutions which are primarily in the business of investing in and managing a portfolio of equities by pooling their funds of thousands of investors. The companies may offer a variety of services in addition to diversification, including professional management of their financial assets. And so they may do a number of things, other than just giving you the option of or the vehicle for you to invest. There are other issues that they can help you with, like the professionalism management of funds. So because you are part of their parcel or their investment unit, then they should be able to assist you in many ways. So this, other than just being part of a customer relationship, it's also trying to enhance or encourage more people to join, or a means of trying to recruit more of their participants or people joining their kind of investment. Now, investment environment. Investment environment can be defined as the existing investment vehicles in the market available for investor and the places for transactions with these investment vehicles. The main types of investment vehicles are, we have the individual
individual stock.
Yes. We have the individual stock. Individual stocks. We have mutual funds. We have bonds, investment vehicles, can be low risk, such as CDS or bonds. We have high risk, such as options and futures. We have other investment vehicles, including lending investment, such as bonds, cash equivalents, and pooled investments, such as pension funds, plans, and hedge funds.
What does it mean CDS? Is that time deposit? CDS. What does it mean CDS? Time deposit?
Yeah.
Deposit? Okay.
Yes. So these are some of the investment vehicles or investment environment. The investment vehicles. So when you talk about, for example, the individual stocks, mutual funds, bonds, other investment vehicles. Individual stocks are like when you buy shares of a particular company. That is a kind of a financial investment. And then mutual funds is where that's where the pooling of resources comes in, where an insurance company has many players who are coming together, or contributors who are coming together, putting money together, and then now we invest as a pool. Just like I was discussing earlier on. Now, things like bonds, they have low risk because like government bonds or treasury bills, those ones are assured, they have assured returns, which cannot fail. So in our analysis, and that's where CAPEM will come in handy, because in our analysis, we have risk-free assets. When you buy government bonds or treasury bills, those ones are referred as risk-free assets. You may have a combination of that in your portfolio, together with risk assets. Like if you buy a share of another company, all right, which is a private company, a private in the sense that it's not government, and then it happens to fall, or it happens to go under. You see, the risk of not getting any returns from your investment. Okay, So you may have a portfolio with a combination of all these kind of scenarios. One that is risk-free and one that is risky. So how do you evaluate this kind of a portfolio? Because you have to consider those ones that are free and those ones that are risky. Okay? And then you have to come up with an appropriate formation that will actually maximize your return. So these are kind of evaluations that we are going to look into, so that when we are making a decision about this is the right portfolio that we need to put in or we need to invest in, then we need to consider some of those factors that will actually affect the returns of a portfolio or the risk of a portfolio. Other investment vehicles include lending investments such as loans, cash equivalents, gold investments such as pension plans and hedge funds. We have talked about pension plans where members who are working under probably the same employer may contribute in terms of pension, and then this money is put together and then invested as a pool, all right, in a way to enhance or to encourage or to create some return or some benefit for these people when they. Okay, investment into physical assets and financial assets. So we have two types of assets that one can invest in. We have financial assets and physical assets. What's the difference? And then there are those special assets, those special characteristics that go with the investing in financial assets. Like physical assets is like when you buy land. Okay. Yeah, because that's a physical asset. You can go and see this land, isn't it? Or when you buy a building. Okay. Or when you buy a lorry or a heavy truck, or something that you put your money there that is supposed to generate you some income, isn't it? And that is visible. That's a physical asset. You can also invest in financial assets. Like when you talk of buying a share of a company, there's nothing you are given as something you can hold on that you can say, other than just a document, isn't it? Probably now in Kenya, we don't have documents. There have been these days we have electronics ones. They are called CDS.
CDS, yes.
So when you have a CDS account, then you don't need a paper share, a share in form of a paper.
Okay.
Yes. So everything is done electronically. So if you buy shares of another company, and through your broker or your broker who is an agent, then the CDS account is updated accordingly. So your status changes. You are not a shareholder of this company. You are now a shareholder of the other company. So this is the technology and all these variables have come in to change the dynamics in which we can evaluate this or this kind of investment. Now, there are those characteristics that go with financial assets, and which is more of a concern. We are not concerned about buying land and selling land. We are more concerned about buying, though land can be part of it, but we are more concerned about financial assets, because this is where the understanding of the market is very critical. The variables keep on changing. They are very dynamic. They are not static. All right. So they keep on changing. And this is where we are more concerned about. So financial assets are divisible, whereas the physical assets are not. Asset is divisible if investor can buy or sell small portion of it. If you buy, like, for example, a share or 1,000 shares of a company, a given company, you can decide to dispose of half of it and retain a half of it, isn't it? So that is what we are talking about, the visibility of this share, of the financial assets. So it's easily divisible than physical assets. Assuming you want to divide land so that you sell part of it, it's a whole process, because you'll have to go to lands, I don't know, register of lands. I don't know whether that is happening in that place of yours. Register of lands, so that you get two different title deeds. Is that so? One for another parcel, another one for another parcel, and you may have waited for long and paid a huge amount of money. So this is what you're talking about. Divisibility here is the easy of disposing of part of your ownership and retaining part of your ownership. When you are in need of funds, sometimes this can be easily converted. Like if you are in need of funds and you own land, you have land, converting that land into liquid cash is very hard, because you have to advertise, reward, different process. Mm-hmm. But when it comes to like shares, you just decide, I can sell part of these shares or a percentage of these shares, and then retain part of it. And then when I get money from this portion I will have sold, I'll be able to sort out this and that. So these are some of the things that we're talking about. Then another aspect that is very important for financial assets is marketability or liquidity. And I've just alluded about that, because you can easily convert it into liquid cash. Like if you are holding shares of a given company and you are in need of liquid cash, you can easily dispose of this share and then now get cash to sort out your issues. All right. So when you talk about marketability, it's actually the easy of converting your asset into liquid cash. This is not easy with the physical assets, right? Which are actually usually have low liquid level. Like if you are to convert, like for example, in our previous discussions, we talked about the current assets, the liquidity ratio, where we had current assets over current liabilities. And then we talked about the quick asset ratio. All right. Why were we eliminating stock? because it's not easy to convert stock into liquid cash. So the same applies here. Think about it from that perspective. The same applies here. Converting like stock or assets, like physical assets into cash may require some extra costs or a lot of time than if it's a financial asset. So marketability reflects the feasibility of converting the asset into cash quickly and without affecting its price significantly. Most of the financial assets are easy to buy or sell in the financial markets. Investors acquiring physical assets usually plan to hold it for a long period. So if you are intending to buy like a building, I think in most cases, if you are buying a building, the intention may not be to buy and sell the following day. All right. In most cases, the intention would be to buy and hold on it for quite some time, for a longer period. Okay, because it's the capital required is huge. All right, and even the process of disposing it is so rigorous that it needs time and all that. So people to go into that, then they must give it a special time and a special amount because of that, they may intend to hold the asset for a longer period than the financial assets. Then information availability, that's another aspect of financial asset. Information availability is about financial assets being often more abundant and less costly to obtain than information about physical assets. I don't know what happens in your place, but we have Nairobi Securities Exchange, which the tradings that happen on a daily basis are published in the media. All right, in the print media on a daily basis. So, like today is Friday, the happenings or the tradings that took place today will be published in the tomorrow's print media, so that people can understand or can read and appreciate the trends, all right, that are happening in the stock exchange that you're dealing with, or the general public may be dealing with, or may intend to deal with. So the same thing may not be possible for these physical assets. Assuming we have a stock exchange or an exchange where we have land sellers and land buyers, you know, that one may not work. All right. So what you're talking about is the information availability. Again, these companies, like one of the requirements for companies which are listed on the stock exchange is to publish their reports, their financial reports, in the media. All right. So once they publish that in the media, then they are availing the information to the general public about their performance. And so the general public get to be informed about how the organization is performing, and therefore they can make informed decisions. So the issue of information availability is critical when it comes to the financial assets and in the physical assets. You may find that some information about physical assets is so private that only a few may just get to have it, and not everybody else. So that's why we bring in now the issue of information asymmetry. Information asymmetry is a critical element in the analysis of projects, because what information is available about this project? How do you project the expected returns of a project? How do you project the expected risk of a project? It's through the information that is available in the market. So that is a very important aspect that needs to be part and parcel of portfolio analysis and portfolio management. Since a big portion of information is important for investors in such financial assets as stocks, bonds, is publicly available, the impact of many disclosed factors having influence on value of these securities can be included in the analysis and the decisions made by investors. So information is critical, because if you are informed, then you are bound to make informed decisions. And you are different from that one who does not have the information about certain issues which are critical to or relevant to the decision-making process. Then you'll find the kind of decisions that they'll be making will not be that realistic as they ought to be. Then we have the main types of financial investment vehicles. Now, these are the financial investment vehicles. All right. We have short-term investment vehicles. We have fixed income securities. We have common stock. We have speculative investment vehicles, and we have other investment tools. So I will analyze each one of them in itself, and then trying to explain what it means and how we can go about it, and giving some of the examples that one can give under each category. Okay. Any question, comment?
No, it was good.
Irma, are you there?
Yes, I'm there.
Are we together, or you've
Yes.
left me alone?
No, I'm with you. Now it's better to continue tomorrow.
Better to continue tomorrow?
Yeah.
Emebet,
I'm a
Yes,
bit.
we continue tomorrow. You're tired?
yes, that was good.
Okay. So I think if we can agree, we can continue with that tomorrow, and then we'll talk about each one of them.
Okay.
And introduce the process of actually it's called the investment management process. Okay.
Okay.
And then after that, we'll go now into the quantitative analysis of projects.
Okay.
Any question?
No, we don't have.
You don't have? Okay. Now, Girima, did you
Yes.
receive the notes I sent?
Yes, the last note is financial ratio.
Yeah.
Yeah, I share them.
Okay. So tomorrow after we go through this, I will also share this
Okay.
so that we are moving together.
Okay.
And then I was also supposed to include, there was one of us who joined us later. He was called who?
I'm a bit.
Where are you?
MLF.
Yes.
Yeah.
Emebet Negeri.
Yeah, I'm
Okay.
Mabek Nagari.
You don't have an allocation for you to research and present?
Which result, Doctor? Sorry.
Now, Girima, do you know your area of presentation?
You could not allocate for them, for she.
But do you know yours?
Yours?
Like for you?
Yes, I know.
Which area?
Security and investment, financial markets.
Financial markets.
Yeah.
Emebet, do you know your
Security
area?
markets.
Which one?
You could not assign for the Mabit.
Huh?
She is new coming.
Emebet.
Hello, doctor.
Yes.
You could not assign. Assignment ነበረንና assignment allocate አደረገልሽ ምን አንቺ presentation አለ እሱ ነው የሚጠይቅሽ
ኦኬ እዚህ ልጅ
Hello, doctor.
Yes.
ዝም በለስ
Emebet does not have an area.
yes you
Yes,
couldn't
doctor.
allocate
Okay, then I will allocate her
yeah
Okay.
an area and then resend now the updated course outline with the area,
okay
with her area also concern. Yeah.
so very good okay
I think the rest, all the rest have, huh?
yes you have
Okay, good. So thank you so much for turning
Okay.
up and hope to
night.
see you tomorrow.
good night okay
Good night. Thank you.
ልዩነት መፍጠር ዓላማችን ነው። ዓለም አቀፍ ተወዳዳሪ መሆን አለባችሁ። የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ጥራትና ደረጃውን የጠበቀ ስልጠና በመስጠት ብቁ ዜጋ እያፈራን ነው። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆቴልና ቱሪዝም ሙያዎች አሰልጥነን ተወዳዳሪ እናደርጎታለን። ኮሌጃችን ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ICM ጋር በመተባበር ዓለም አቀፍ ዕውቅና ያለው ስልጠና እየሰጠ ይገኛል። በፍላይት ኦፕሬሽን በበረራ መስተንግዶ የምንሰጣቸው ስልጠና ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና አለው። አድራሻ ከጎላጉል ታወር 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ህልሞን እውን ያደርጋል።